Italy's public debt is rising steadily, posing a growing challenge for the country. Italy's debt to GDP ratio. In 2005, it was around 105% at the height of the global financial crisis. In 2009, it exceeded almost 120%, and in the years leading up to the COVID-19 pandemic, it reached around 135%. This relentless rise in debt was the result of increased government spending and tax cuts introduced to protect the economy from the effects of the pandemic. Unfortunately, the weakness of the Italian economy had a negative impact on government revenues. In addition, the closures further reduced economic growth, which further increased the need for borrowing. As a result, the ratio of public debt to GDP has risen to its current level of 150%. This rising debt poses a serious threat to the stability of Europe's single currency. The fate of the eurozone in the coming years will depend on how Italy deals with this debt. In an attempt to generate inflation, central banks have drastically cut interest rates to zero or below over the past 2 decades. They have also expanded their balance sheets to previously unimaginable levels. The European Central Bank has been particularly aggressive, introducing negative interest rates of -0.5% on euro deposits and expanding its balance sheet by 8.5 trillion in assets, 4 times the amount at the start of 2015. The biggest concern, however, is Italy, both because of its size — it has one of the largest government bond markets in the world — and the rate at which its debt is growing. Under the eurozone's pacts, member states are obliged to keep debt levels at a maximum of 60% of GDP. Unfortunately, Italy is increasing its debt at a rapid pace, reaching around 155% of GDP this year. This is an increase of 50 percentage points compared to 2007. To make matters worse, the Italian economy is heavily dependent on the European Central Bank for financing. It does not have many options outside the ECB. This is a serious problem and is evidence of the lack of effective reform of Italy's financial system, which in turn is exacerbating the current problems. Italy faces an increasing burden of rising public debt. This growing debt is becoming an increasing burden for Italy, with the country running a budget surplus in some years if the cost of servicing the debt is not taken into account. For example, between 2011 and 2019, Italy has an average budget deficit of 2.7% of GDP. However, if debt servicing costs are excluded, the surplus will be 1.4% of GDP. This phenomenon is also present in other countries such as Portugal and Spain, but the scale of the problem is much greater in Italy and Greece. Italy recorded a large budget deficit of 7.2% of GDP in 2021, only slightly better than the record deficit of 9.6% of GDP in 2020 due to the pandemic. In the years before the pandemic, the ratio had been around 2.5%. In the first quarter of 2022, however, it rises to 9%, compared with an EU and Euro area average of around 3%. As Italian government bond yields rise, mainly as a result of rising interest rates and increased risk, newly issued Italian government bonds become significantly more expensive than those issued during the period of zero interest rates in the euro area. This increases the cost of servicing the debt, which rises further in nominal terms. As a result, Italy had to spend more than 4% of GDP on debt servicing in the year before the pandemic, which amounts to an astronomical $84 billion. This worrying trend could pose a serious threat to the sustainability of public finances in Italy and the euro area as a whole. The bond market has become an arena in which the eurozone could collapse. The main risk factor is the growing debt crisis, which brings with it a number of other potential risks. Italian 10-year bond yields have risen steadily since the beginning of the year due to a combination of factors, including quantitative tightening, interest rate hikes by the European Central Bank, and economic problems in Germany and the rest of Europe. In addition, foreign investors have become increasingly reluctant to lend to the Italian government due to political uncertainty and instability in the energy market. Italian bond yields are currently at 4.8% and rising. This definitely increases the burden of servicing Italy's public debt. It is worth noting that in 2018, debt servicing consumed around 4% of GDP annually, while the yield on Italian 10-year bonds was only 2.35%. This has now more than doubled, and there is a real risk of a recessionary scenario that could lead to a fall in the inflation rate. Such a scenario risks a sharp rise in debt servicing costs relative to GDP. It turns out that this ratio, and not the level of debt per se, is the key factor affecting the sustainability of public finances. If the Italian government does not address the liquidity problem caused by capital flight from the Italian bond market, and if the European Central Bank is unwilling to continue financing its member states' deficits, there is a real risk that fiscal policy will become pro-cyclical in a recession. This means that public spending will have to be cut while the economy is stuck in recession, reminiscent of the 2011-2014 period. The pressure of rising Italian bond yields in the face of a depressed economy represents a very serious risk of a fiscal crisis that could lead to the breakup of the euro area. Italy faces a serious risk of bankruptcy in the face of a potential downturn in the European economy due to the worsening energy crisis. The country's debt problems have been around for many years, and while the economic recovery following the 2008 and 2011 crises helped them recover, Italy's debt problems remain a difficulty that will resurface in the event of a downturn. It is worth noting that Italy is more exposed than other southern European countries, not only because of its high nominal debt level, but also because of its term structure. Italy has a higher proportion of short-term paper and will need to refinance around 35% of its debt by the end of 2024. For Spain and Portugal, these ratios are 25% and 20% respectively, which means that Italy is more exposed to rising bond yields, which will have a faster impact on rising debt servicing costs. It is also extremely worrying that Italy is heavily dependent on Russian gas and oil supplies, which means that an energy crisis could have a major impact on the health of the Italian economy. Such a situation poses a huge challenge for the government, especially given the already existing problems such as debt, the possibility of recession, rising interest rates, and inflation. This is a catastrophic scenario that could become a reality for Italy. Italy has suffered a serious economic and social collapse in recent years. In absolute terms, the country's GDP index fluctuates around a constant $2 trillion. Between 2010 and 2019, the average GDP growth rate has been close to zero. Although there has been some growth in GDP per capita since 2015, it is still lower than in 2005, which clearly shows that Italy cannot be considered an economically successful country over the last 2 decades. The structural problems of the Italian economy have also contributed to this collapse. The low concentration of the population in cities, where it is easier to find more productive jobs, and the economy's overdependence on tourism make it difficult to add value to the economy. But these are not the only factors contributing to the difficult situation. Italy's high public debt is largely the result of low nominal economic growth, which makes debt reduction even more difficult. Italy's economic problems are compounded by its demographic collapse. The birth rate has reached a historic low, with the number of children born last year falling below 400,000, 393,000 to be precise. This is the first time since the unification of Italy in 1861 that the birth rate has fallen to such a low level. Since 2008, the number of births has fallen by 184,000, a trend that has intensified since 2019. As a result, deep stagnation has become synonymous with the Italian economy, coupled with the constant risk of a financial crisis erupting at any moment. With the European Union's third-largest economy growing at such a drastically low rate, Italy has been stuck in a deep socio-economic crisis for years. Reconstruction and economic reform appear to be key to reversing the current trend and restoring growth. The current situation in Italy confronts the euro area with 3 possible solutions. The first scenario is for Italy to go bankrupt. However, such a solution would be extremely problematic, as much of Italy's debt is domestic, meaning that losses would be borne by its own citizens. This is a difficult concept to accept. The second scenario is for Italy to leave the eurozone. From Italy's perspective, This exit would have the advantage that losses would be borne by creditor countries such as Germany. But such a solution could be more complicated than Brexit and generate considerable controversy. A third option is to introduce some form of debt mutualization. Moving debt management from the European Central Bank, ECB, to a dedicated agency offers hope for the future. The former head of the ECB, former Italian Prime Minister Mario Draghi, and French President Emmanuel Macron have signed a letter calling for all eurozone debt since 2007 to be transferred to such an agency. However, such a solution will face resistance from Germany and eurozone countries trying to reduce their own debt. For the eurozone to survive, a compromise will be necessary. But the problem is that creditor countries are unlikely to agree to such a solution. At the same time, the potentially serious problems that could arise from such a move include the threat of an Italian exit from the eurozone. The situation remains difficult to resolve, and the future of the euro area is uncertain. Thank you for watching the video. Leave a comment and subscribe to the channel. See you next video.